Welcome in, investors. So Medical Property Trust is having an awful day. This was a $25 stock a few short years ago, now trading at $3.50. We're going to get into what exactly has been going on. As most of you know, I did give you guys kind of the warning signs of Medical Property Trust. A few years ago, I was looking at Medical Property Trust. I actually thought it was an interesting company at the current price. We saw some mismanagement taking place and not great diversification when it came down to tenants. Getting into a higher interest rate environment, they had a lot of refinancing to do, and it's just everything's going the wrong way for Medical Property Trust. So in this video, there's two specific stocks I'm going to talk about. We're going to talk about MPW really quick, but I also want to dive into CVS, as this was a request by a subscriber to kind of dive in their business model and where I think the opportunity is. So let's get into it. Now, Medical Property Trust is America's largest hospital landlord, and we can see here they have 441 properties. Licensed beds are 44,000 in 10 different countries and 55 operators. And you can see visually right when the hiking cycle took place. Take a look at Medical Property Trust. Now, these are obviously multiple headwinds besides just the interest rate environment. We obviously heard about tenants falling behind in rent. Seemed to be a lot of mismanagement. CEO steps down, and so now the stock is down 30% intraday as the stock hits a 14-year low and tenant falls behind $50 million on rent. Obviously, with this news, you get downgrades, and the stock has now approached 2009 levels when we talk about the stock price. And this has been kind of my problem with REITs right now. I know that the market's had a substantial rally, but we have to remember interest rates are still elevated for longer. The whole real estate sector in itself has a tremendous amount of refinancing coming due over the next few years. And the landscape for commercial real estate specifically is kind of uncertain at this point in time. Now, that obviously can lend an opportunity for somebody who's a little bit more sophisticated on that aspect of real estate. So Medical Property Trust is accelerating efforts to collect outstanding rents and loan obligations. And now MPT is hiring financial advisors to kind of see what the next steps are to really bridge this problem here. And now they're getting a bridge loan to kind of put a band-aid over this massive wound here. So just a few things to talk through when we're reading this. Number one, obviously they're not collecting rent and they're taking on debt. So this is obviously going to make cash flow a massive problem here until rents can get collected. Because of the bridge loan that they're taking, collateral against their assets, there's going to be a higher interest rate attached to this. They also have debt that they have to refinance soon, which we'll get into. We can see real estate assets are coming down due to some sales of real estate assets here. Cash and cash equivalents is sitting at $340 million. So we see a low liquidity position for MPW now having to handle Stewart not paying rent. So while MPW is trying to bridge the gap with a $60 million loan, Stewart is now pursuing several strategic transactions, including the potential sale of re-tenanting certain hospital operations as well as divestitures of non-core operations. And there can be no assurance that Stewart will successfully execute this plan. Now, I'm not sure if this is 100% true, but in this article it states that the complete removal of Stewart-related investments, including that from the Massachusetts partnership, would have negatively impacted 2023 report adjusted funds from operations by approximately $67 million or 11 cents per share. And so when we look at what they earned for the quarter, it was 19 cents, and they're basically saying that it would have been a negative impact of 11 cents. So we can see here that maybe they would have earned roughly 8 cents a share. But then when we look at the dividend payout being 15 cents a share, payout ratio is definitely going to be a problem here even after the dividend cut. Now, one of the things that this article is really not talking about, or that's not being stated, is the cost of that bridge loan and the charge-offs of not collecting those rents. How is that going to negatively impact MPW's earnings? Maybe you're still looking at breaking even for an EPS standpoint, which means that dividend's probably going to be halted here temporarily, I would imagine. So we're seeing why the massive sell-off is taking place. It's get the heck out of the way, ask questions later. There's a tremendous amount of problems here, as we can see with MPW, Stewart Properties, and kind of just the low liquidity factor, the fact that operating income has shrunk drastically, and now Stewart is causing even more and more problems for Medical Property Trust, refinancing questions down the road. Is the dividend even safe? And I think what you have to do at this point in time is kind of just sit back, let the chips fall where they may. I would give it one or two more earnings report. We'll probably have a better understanding of exactly what's going on by June or July of this year. So, if you've been looking at the stock or you've been curious to what's going on, I definitely think it's like a 50-50 that the company could get through it or the company could actually go bankrupt. It's a very, very fine line, I think, that they're walking. And when we look at the diversification of them, Stewart making up over 20% of their properties, over 20% of their assets, you know, it's not just them not paying rent, it's the cost of attorneys, it's the cost of refinancing that also take effect into those earnings per share as well. So this one will be an interesting to watch. Hopefully you guys enjoy that. Let's talk about CVS. So now I want to talk about one of my bullish positions in 2023. And unfortunately, yes, I did sell out of this one. My cost basis was sitting right around $64, $65. And I can see the bull case and the bear case for CVS as more companies are now entering. As the pharmaceutical side of the business is definitely getting competitive, people are threatening to come in the space and be cheaper and more efficient. And all this is true. But when I look at CVS's opportunity, it actually starts with a different aspect of the business, and that's going to be the EIDA side of their business. So while I think, you know, there's going to be a setback in some of the pharmacy stuff, I'm going to explain why I don't think it's that big of a deal longer term for CVS. And while I still remain bullish on the stock, I probably wouldn't be chasing it at these levels because I do think around $90 a share is probably where it's going to tap out at. But if it did get back into the 60s once again, I would be interested in getting back in the position. Anybody that's been subscribed to the channel knows that I had right around a $56 to $65 stock price from a multiple of EBITDA here. And this is using pretty conservative growth rates sitting around 4%, 2%, and 2%. Now, this is a company that I think does everything solid here. Returns capital through dividends, buys back stock, has grown its EPS. Over the next 2 years, the earnings per share is going to stay roughly flat, sitting right around $8.50 a share. But with the stock price sitting around $80, you're basically looking at a stock that's trading around 10 times earnings. When we look at top line revenue, this is a company that was doing $150 billion revenue in 2015 and is now pushing over $330 billion of top line revenue. Most analysts had a price target over that $65 price target that I gave, sitting at 76, 93, and 143. So even from an analyst expectation standpoint, if you were able to get the stock in the 60s, you probably did fairly well for yourself because most analysts had it priced well above that. So I'm going to explain why the EIDA side of their business, to me, is possibly the most important side. They're serving more than 100 million customers across CareMaker and EIDA, and there's 5 million people that walk into their stores basically on a daily basis. And so now CVS acquires Oak Street Health, picking up 169 medical facilities in 21 states, and this was an all-cash deal. So they acquired EIDA, they acquired Oak Street Health, and all these acquisitions you were basically getting for free when you were buying CVS in the 60s, and that's where I thought this company was extremely worth the risk versus reward at those levels. Because you're basically buying the CVS storefronts for $60 a share, but you're getting EIDA and Oak Street and anything that can come from these acquisitions pretty much for free. And so this is where the business got very, very interesting because the efficiency and the ability to possibly expand margins is where this is going to get powerful. If they can find a way to still build that flywheel out, expand margins, then the cash flow opportunity for the company is very, very strong. So let me explain why I think CVS's business model is extremely powerful here. Now, obviously the medical field is changing drastically, so it's something we need to keep an eye on. But this is my opinion and why I think there's a lot of untapped potential with CVS still. So the EIDA and Caremark deal is where I want them to focus. I'm going to explain why. They have over 100 million users on this platform. These are premiums collected on a consistent basis. Now, why I don't think the CVS pharmacy itself is really going to get in trouble here, and I'm going to explain why that is. I know people that have EIDA, and what CVS is doing as a company is pretty interesting. They kick back premiums to people that are under EIDA, and they do it in the form of a credit to CVS. So a couple relatives of mine get $75 a month and a booklet of CVS products that they can buy every month, and they can go in the CVS and use that $75. So what does that do? Yes, they can charge a little bit more on the upfront for the premiums, but you get a lot more as an individual on the back end here. It's going to drive traffic into the store, and maybe some of the products that are not in the book, you're still going to pick up at CVS because you're already there, whether that's soda, candy bars, but you have the ability for XX sales due to the fact that people are coming in for their store credits. We really want to see more and more people get onto the EIDA platform, and that'll drive more traffic to CVS. Now, of course, if you have the common cold or you need remedies right away, you're probably not going to order it from Amazon because you're still going to take time to get those remedies to your house, but you can drive to a CVS for those emergency moments. So there's still going to be a certain amount of traffic that goes to CVS. And not every company is going to go direct to consumer. Now, maybe that can change down the road, but even if it does, I don't think it's a massive problem because of the way they're setting up the EIDA and CVS partnership here. And so the big question mark I have is actually not going to be the CVS and EIDA deal here that's working out really well. I think that's going to drive a tremendous amount of traffic into CVS, both from EIDA users, but obviously people that live around the area that still need the everyday remedies. But where it's starting to get interesting was the acquisition of Oak Street. How is this going to be implemented here? As I stated, 169 facilities in 21 locations. Does this add some sort of cost savings being part of EIDA? What are they able to do? Are they able to grow margins? So this is going to be something that we start to uncover over the next probably 3 to 5 years. And the other thing that's not getting mentioned enough is CVS did make an $8 billion acquisition of home health and technology company Signify Health. So now we have Oak Street and Signify Health. So I know this looks really messy, but to me, the main focus is going to be getting a lot of people paying premiums on the EIDA platform. From there, you're going to get your spillover effect to CVS. And so my question is, how is Oak Street and Signify Health going to complement the EIDA side of their business? What is the competitive advantage that they're building to having EIDA, being able to shop at CVS and get credits, maybe having home health services, but also maybe being able to cut margins because they acquired Oak Street. So this is going to be the next side of their story that's going to be playing out over the next 3 to 5 years. The EIDA CVS side has been playing out over the last few years. We're starting to see more people that have EIDA services now shopping at CVS because they get the credits and you get discounts. So it's going to drive more and more traffic to their pharmacies that are kind of dying off here because of companies like Amazon. But doing this and being able to complement it is doing two things. Number one, it's putting a bid under their storefronts, meaning people are still going to need them and traffic's going to be driven there. Number two is it's actually storage for the company. If they didn't have all these storefronts, they would still need to find places to store these products. And not only do they have a place to store the products, but you have a pharmacist that you can talk face to face with. So there is some sort of benefit here walking into a pharmacy and being able to communicate directly with a pharmacist and being able to have all the storage you need for all your remedies right there in the storefront. So this is kind of my dive into the bullish case. Obviously, the bearish side here is that there's a lot of question marks with recent acquisitions and how is this all going to play out. But the truth of the fact is this is a company that is spitting off a tremendous amount of free cash flow. Margins are fairly thin, which is a concern of mine. But it's a well-run business that's buying back stock, paying dividends, still growing, and has tremendous levers to pull here as we're seeing by the recent acquisitions. And as I stated before, when you look at the valuation of the company, it is very reasonable paying 10 times earnings with all these businesses under their umbrella. So as always, really appreciate everybody's time. Thank you so much for spending it with me, and we will see you in the next one.